capital gains tax. Because anytime you make money doing anything, the government's always going to ask for a piece. And that is no different when it comes to your investments. Without understanding the taxes that get tagged on to our investments, you might be investing recklessly. However, if you want to optimize your investments so that you pay the least amount you possibly can when it comes to taxes, then you're going to want to stick around for this one. Welcome to Finance for Everyday People. I'm Jeff Mora, where I teach you all about your personal finances like you should have been taught. Before moving forward, if you haven't seen my video on income tax and how that gets calculated, then please check out that video first because capital gains tax only builds off of that one. If you're still here, then I guess that means you've watched it. So let's jump into it. So capital gains tax is literally just taxes on any money you've made from any of your investments, whether it's stocks, different types of funds, crypto, real estate, all that falls under capital gains tax. But the key word here is profit, because we all want to make money with our investments, but we're not actually getting taxed unless we're making money. Let's jump into a few definitions, starting with unrealized return. See, because even if my investments go up, I'm not making a profit until I actually sell that investment for more than what I paid at least. The moment I actually lock in my return by selling whatever investment I'm talking about, then that becomes a realized gain or a realized loss, depending if I made money or lost money from it. You can imagine two different people with the same stock in their portfolio, and that stock drops 20%. The first person decides to keep holding, so even though they're losing money, it's unrealized because they haven't actually done anything with their investment. But then there's somebody else who saw the drop in the stock price, and they take that $20 hit by selling off their stock that they initially paid $100 for $80. And we can call that realized loss a capital loss when it comes to the context of taxes, since there are some tax benefits we'll talk about later. Now, the ideal situation is to trigger a capital gain. And this is actually making profit from an investment where you sell and realize those gains. In the same situation, someone who owns this stock in their portfolio does not sell after seeing the stock price jump 20%, but the second person does and actually receives a real $20 bill because they were able to flip the stock they owned for a higher price. This is what we all hope to do as investors. So we can see how the tax triggers because we made profit. However, the amount we're taxed depends on how long we've held that investment for. When it comes to capital gains, there is either a short-term gain or a long-term gain. And it's literally just if you held the investment for under a year or for longer than a year. The reason this is important is because we have a better tax rate if we have a long-term capital gain. In other videos where I talk about compound growth and how you want to let your investments ride for as long as possible, long-term capital gains tax is encouragement to keep up that compound growth strategy since they offer lower tax rates. As we go into these different tax regulations and investment account types, you'll start to realize that compound growth is actually very encouraged by the government. That's something to just always keep in mind. Let's take these two topics one at a time, and we'll start with short-term gains. The way it's calculated is just like ordinary income. Let's say someone makes $80,000 from just their regular employment income. That's their salary they get from their job each year. That person might have also bought some stocks, some ETFs, and flipped them for a higher profit, but they flipped them in under a year, resulting in a $2,000 profit or a short-term capital gain. Those two add up to a total income of $82,000. When it comes to file their tax return, they take the standard deduction of $15,000 and their taxable income becomes $67,000. That person gets placed into the same tax brackets as just regular taxable income. In this example, the person is a single filer, so these are the tax rates. In the income tax video, you might remember this scenario. It's the same math, just with an additional $2,000 because of that short-term capital gain. you can work out the math of how much they owe per tax bracket. And in total, on that $67,000, they owe $9,452 in taxes. The biggest takeaway is that short-term capital gains are taxed just like ordinary income. So it's literally like you made that money from your investments as you would money from any other job you've worked. The benefits come when you've held that investment for longer than a year so that you trigger long-term capital gains tax. Just like income tax, long-term capital gains also has its own set of tax brackets. I'll quickly throw up the income tax bracket for 2026 here so that you can get an idea of how much you're getting taxed at for each bracket. But now let's flip to the 2026 long-term capital gains tax brackets. And you can see that these ranges are wider and at lower tax rates. I am specifying the 2026 rates because they will be different as time goes on, but long-term capital gains tax brackets are always going to be lower than income tax brackets. Feel free to pause the video and flip back and forth to really see the difference. Now, don't assume if you make under $49,000 in capital gains long term that you get taxed at 0%. The big idea is that your total taxable income is your ordinary income plus these long-term capital gains. That determines the bracket you get placed in. But only the long-term capital gains of that income gets taxed at these rates. If that sounded confusing, don't worry, let's walk through an example. The same character makes $80,000 from their job. When it comes to filing their taxes, they take the $15,000 standard deduction. This brings their taxable income to $65,000. Now, if they made, say, $5,000 from a long-term capital gain, like they've been holding a stock for years and then finally sold it for a $5,000 profit, then that gets added to their total taxable income, $70,000. Notice the difference with short-term capital gains is that that profit gets added after the standard deduction. Now, even though our total taxable income is $70,000, we still have to keep track of how much is ordinary income versus long-term capital gains. Because the $65,000 that is ordinary income is taxed at the regular income tax brackets. That $5,000 gets taxed with the long-term capital gains tax brackets. However, the full $70,000 is what determines your placement in those brackets. And so when we calculate our total taxes owed, we can split it up into two parts. One is ordinary income, which is no different than just earning $65,000 on your own. The second part is that long-term capital gains of $5,000 getting taxed at 15%. It's 15% because their total taxable income of $70,000 falls within that $49,000 to $545,000 bracket. We can do the math out, and for that $5,000 gain, we pay $750 in long-term capital gains tax. Add that to the total amount of ordinary income tax, and we end up paying $9,762 for the year. Feel free to pause the video here to really understand and digest all of this. Next up, I'll actually prove to you why long-term gains are better than short-term gains because of this lower tax bracket system. Here is a summary of both our examples side by side. Because short-term gains get taxed as ordinary income, our total taxable income of $67,000 triggered a total tax owed of $9,452. Compare that against our lower tax rates on long-term capital gains. Our total taxable income of $70,000 triggered a total tax owed of $9,762. Now that number might seem higher than in scenario one. However, if we look at the effective tax rate, then relatively speaking, we're actually paying less in taxes. Because we're paying an overall effective tax rate of 14% with our long-term scenario versus 14.1 in our short-term scenario, then selling off gains long-term actually kept more money in our pocket. So that's how short-term and long-term capital gains tax works. But that's assuming you have a realized gain. If you sell an investment for less than what you paid for it, realizing that loss, then instead of triggering a capital gain, you actually trigger a capital loss. And these can actually reduce the amount of taxes you owe, offsetting any capital gains or just regular income. Looking at two scenarios, our first character sells stock A for a $5,000 gain, but then sells stock B for a $3,000 loss. That still creates a net capital gain of $2,000. And dependent if that was short-term or long-term, they get taxed on that amount appropriately. Scenario 2, however, has someone selling stock A for a $1,000 gain, but selling stock B at a $4,000 loss. That makes a net capital loss of $3,000. But that $3,000 then gets subtracted from your total taxable income. So in our old example of someone making $80,000, claiming a $15,000 deduction, taxable income is $65,000. Subtract this capital loss off, and they're only being taxed at $62,000 for the year. It's important to note that $3,000 is actually the highest amount in capital losses you can reduce your ordinary income by. But if you do have more, then you can carry over that extra amount as losses for the following year. Hopefully, taxes make a little bit more sense now. We covered how capital gains and losses work, as well as why some investment profits aren't taxed the same. Knowing where you're losing some of your profits will then help you understand how to optimize your investments. In later videos, I'll uncover account types that are actually designed to reduce and sometimes even eliminate these taxes. But until then, I hope you enjoyed. If you did, drop a like, subscribe, and I'll see you next time.